Hello everyone, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This will be for Friday on February 17th, the close, getting ready for Tuesday's open on the 21st. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report, for those of you that like to time the entries of your condors and butters in a more specific, detailed manner. And for those of you more statistically oriented for the whole market, in either direction in volatility, we have the Directional Likelihood Report for the S&P 500. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get going on the reports, just want to remind you, you could get a free ebook by clicking on the link, and also we would like to invite you to subscribe to this so that you get alerted whenever we come out with new updates. The current market condition is as follows. At the end of Friday, we have a situation where we are trending above the 50-day simple moving average. In terms of price action, Thursday was an upswing day, and then Friday actually ended out being an inside day, just barely. So Friday was just barely an inside day, well above the 50-day moving average. Look at the stochastic down there. We are in deep overbought territory. I'm labeling it just between 70 and 99, and we are actually above that 3-day simple moving average of the 15.3 stochastic. So this is a fairly unique market condition. Under these definitions, it's occurred between 80 and 90 times since January of 2000. Okay, so that's the current market condition, and when we reference this, these are the details that we're talking about. Let's go to the reports themselves. For those of you that are acclimated to the methodology behind this, I'm just going to go through the results, and then for those of you that are brand new, we're going to then go through the methodology behind these reports. But first, let's just go to the results so that those that are versed in this can get on their way if they so choose. So, on the Condor Butterfly Timing Report, where we're trying to time the entries using some technical analysis, okay, I'll just read this narrative and go over this, because this is the report we come out with. So again, this is for Friday the 17th. Since January of 2000, there have been over 4,200 daily closes of the SPX. Okay, of those 4,200 plus, 64.9% have been favorable bars for selling premium where the actual movement over 21 days was less than the CBOE SKEW adjusted implied movement. Okay, almost 65%, 64.9, ended up being favorable. That's the baseline. Also during that time, the current market condition, which I just showed you, all right, has occurred 81 times. Okay, 81 times. Now, of those 81 times, 77.8% of those bars were similarly favorable for selling premium. This implies an option premium selling edge of 12.9% when you take 77.8 minus 64.9. That's a great edge, folks. For those of you selling, premium through condors and butters, keep that in mind. This looks like a real good time. Now, does this mean automatically that you're going to make money? No. Okay, you could still have an occasion, you still have 22.2% of the time where the market moved more than what was implied. Okay, it's just that the current market condition is that statistically, it's more likely than normal that Friday's bar will end up having been favorable for selling premium through market neutral strategies. Okay, so that's the timing report for those of you that trade butters and condors. Those of you more statistically oriented, let's take a look at the likelihood report, and we'll dive into the methodology here. Basically, we have 3 volatility bands to the upside, 3 to the downside. The historical distribution baseline is at the top, where those bands are struck between 23 and 32% of the time. Under the current condition at the close, they are struck far less often, all across the board, and we have lots of red numbers here indicating overall lower market volatility in both directions. Okay, does it mean that the market will be less volatile? No, it's just that these bands were struck far less often under our current market condition than just the broad baseline here that you could see. Then when the market goes above the previous day's high, like on Friday's high, then in those situations you could see similarly that the market fails to reach those bands more often than normal. They fail to reach those bands. And then when the market exceeds the low of Friday in this case, similarly the market fails to reach those bands, particularly the upper bands get failure to reach those quite a bit. All right, so that's the picture we have. Let's go into, and also when we recast those bands using the skew adjusted VIX, similarly you have red numbers across the board, and the market is failing to reach those in great degrees. Now, you still see here the market can reach those bands. It has in the past, but clearly not near as often as normal. Okay, now let's get into the methodology. I think that gives us a real good picture as to the market condition we have and where we're going. Let's dive into the methodology now. The Condor Butterfly Timing Report. We'll examine why you should look at this, the methodology, and we'll dive into the details of the current market condition and those edge levels. Sometimes when you look at the market and it begins to channel, you would be tempted to say, oh, it's going to keep channeling. Well, when you run it through the algorithms we do, it's not always the case. Here back at the end of 15, we had a negative edge as of December 31st, and in that case, the market ended up going down quite a bit. But when we say a negative edge, what we're saying here is that there is a higher than usual likelihood that the market will be more volatile than what is implied by the option prices. Okay, based upon that pattern as of that moment in time, when we go back and replicate that pattern in the past, all right, okay, the market was more volatile quite often there, and so there was a negative edge here. In this case, it indeed ended up crashing only, and this is a cherry-picked example, granted, but when sometimes it can be predictive in that sense. So when you have a negative edge staring you in the face, just be aware. Doesn't mean you shouldn't trade butters and condors. Just simply be on your toes and be aware that that particular market condition can lead to more volatile activity more often than normal. Okay? So, the question on the table with this report is our current market condition a good one for selling premium through range trading, condors and butters? Is it a good one? How do we answer that question? Okay, well, first we have to get two types of volatility outlined. First, we're going to look at actual volatility and how much the market actually moves from a given close. That's actual. Then we look at the implied volatility, how much the market move is, what kind of market move is predicted by the option prices. Two different types of volatility. We're going to go back in hindsight, okay, and look at a bar. Look at the actual volatility versus what was implied, and we're going to label that bar either favorable or unfavorable. Okay, let me show you how this works. We can go to any close and then look forward 21 days and examine how far the market moved from that close, up or down. What was the farthest level that it moved? In this case, it moved down 50 points, which ended up being 2.4%. Okay, and we can actually graph that with an indicator down there that you see. Now the question on the table here is, what market move was implied at that time when that close occurred? Okay, in hindsight, we know how much the market moved, what was being implied. And in this case, 4.4% was the implied move coming off of the skew adjusted VIX. That's a lot more than what actually happened. So we would label that bar having been favorable. In hindsight, we're going to go back and paint that bar blue, labeling it favorable. And all the bars that ended up being similarly favorable, we label blue. Others that where the market moved more than what was implied, we're going to label having been unfavorable. Those are red. Of course, the most recent 21 bars don't get labeled anything because we don't yet know. 21 days has to go by first, right? And so every day we're able to look in hindsight and add one bar in hindsight, whether it's red or blue, favorable or unfavorable. Okay? So now, what do we do from here? First, we look at historically what percentage of all the bars going back were favorable. Then we look at only those bars that match our current market condition and examine what percentage of those were historically favorable. And there might be a difference, and that would represent an edge. So if we go back and examine all the bars, about 4,300 almost, 4,300 bars since Jan of 2000, of all those, 64.9% turned out having been favorable. Okay? Now, of those bars that match our current condition with the little diamonds there, we go back and look at all 80 plus of those. Of those bars, what percentage of those were historically favorable? We find out that those that 77.8 of the diamond labeled bars were favorable. Okay, that's a big difference. 77.8 versus the baseline of 64.9. Okay, we have a theoretical edge of 12.9%, meaning that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices based upon the pattern of our current market condition. Okay, so that's the methodology for that report. Very clear. Before we go to the other one, I want to remind you we have a fantastic curriculum at Discover Options. We focus on the one-on-one mentoring experience. You listen to a recording, do your homework, meet with an experienced mentor who trades his own money and that of others as well, and they will walk you through and answer all your questions and do a lot more for you than you probably can imagine. So please give us a call, look at our curriculum. We'd love to customize our curriculum for you to help you get where you want to go. All right, let's look at the market likelihood report now. As I mentioned, that we have a strong likelihood of lower market volatility. The question on the table here is since Jan of 2000, how often has this same condition occurred, and what did the market do in terms of direction and volatility? We know that this same condition occurred over 80 times since Jan of 2000. Okay, what did the market do? If we find out that every time this condition occurred, the market typically went up, well, we'd be very bullish about getting in right now. Or if 100% of the time that of those 80 plus it went down, well, we would be very interested in that, right? So how do we measure that? So here's what we do. First, we look at the historical distribution of price, a baseline historical distribution. Then we look at the distribution of price after our condition developed. Okay, if there's a difference between the two, we're going to tee off on it, okay, in terms of an edge. How do we determine distribution of price? We use volatility bands here, 1 standard deviation volatility bands placed from each bar's closing price. 5, 10, and 15-day bands. We use 20-day historical volatility, log normally distributed. So here's an example here. Okay, we take this close. We take a 10-day band to the upside, a 10-day band to the downside, and we ask ourselves whether the market ended up going up and hitting the upper band, the lower band, or wobbling in the middle. And we're going to record that particular event. Okay, in this case, the market definitely ended up going up, hitting the upper band within 10 days. So we record for that close that it hit the upper band. Okay, oops, time out. Then let's take this close as an example. We have the upper 10-day band, the lower 10-day band. Let's ask ourselves, did it hit the upper or the lower or wobble in the middle? And in this case, it ended up wobbling in the middle. It tried to hit this lower band, failed to. So for that one, we record that it hit neither band. So we record historical distribution like this. For every close, we record whether it struck the upper and the lower 5, 10, and 15-day bands. And we get the statistics on that. Okay, and here it is. Okay, going back to Jan of 2000, there's been 4,289 closes. of those 42.89, it's hit the upper 5-day band 29% of the time, 29.4. Upper 10-day band 23.1, upper 15, 23. The lower bands, it hit the lower 5-day band 29.4, lower 10, 29.2, lower 15, 32% of the time. So that's the baseline distribution of price, encompassing both bullish and bearish markets. Okay, now let's see what we do. Now we're going to look at the distribution of price after our condition developed. So we go to our particular condition, labeled by the diamonds. We're going to examine that same distribution at the close. We're going to examine the distribution if price goes above, in this case, Friday's high. And also, what's the distribution if it goes below the low of Friday, the previous day. That way, when Tuesday comes at the open, folks, you'll be able to have a good bead on what the likely distribution is. And hopefully you can take at that edge if there is one and run with it. So here we have 83 closes. Of those 83 times, price struck the upper 5, 10, and 15-day bands far less often than the baseline. Do you see that? And that's why we have red numbers here. Big differences. It struck the upper 5-day band only 12% of the time versus 29 baseline. Isn't that something? Lower bands. It struck the lower bands also far less than the baseline. See that? So this is a picture of lower market volatility in spades. Let's take a look at what happens if the market goes above the previous day's high. That occurred 53 times in the past. Of those 53, it struck those bands far less often, look at this, than the baseline. Look at those comparisons. That's why we have red numbers here. And the lower bands as well. Far less often. Picture of lower market volatility. If it goes down below the low of Friday, similarly, look at this, much lower values than the baseline. Well, over here, you can see it's kind of getting up a little bit higher, but not much. Similarly, red numbers across the board. Clearly a picture of lower market volatility. Now, what if we recast the bands using a skew adjusted VIX, where the bands are going to be a little bit farther out? On the upside, they're a little closer than on the downside, where the puts have higher volatility, implied volatility. Similarly, red numbers all across the board, folks. Okay. The skew adjusted VIX upside is 9.1. The downside is at 13.4. Let me show you a trade idea using this 13.4 number. The skew adjusted downside implied volatility at 13.4. We could go into OptionVue and look at a hedged bull put spread. Let's do that. What you do is you go into OptionVue, bring up the matrix, click the S button here, standard deviation, plug in 13.4. That establishes our standard deviation. We do a credit spread down here, a standard deviation away. We take some of this credit and purchase an at-the-money bear put spread to hedge this, leaving us with a net credit that represents at least 4% of the net requirement. Okay? When we analyze that, we get a bull put spread where we can make money no matter how far the market goes up. But if it goes down, that hedge kicks in, and we can make 3 times on the downside with this opposed to the upside here, so long as it doesn't go more than a standard deviation to the downside. Okay, if it does go more than a standard deviation to the downside, we're going to get out and probably lose 2.5 times what it is we're trying to make if it stays here 1 standard deviation from the downside, on the downside, okay? So that's an interesting trade when you look at the price chart profit area. The green area, all the market has to do is keep going up or even go up and wobble around a bit, and we're making money here. So that's a real nice high probability profile where you have a hedge on the downside and the market can give you greater profits for all the angst you will have if it starts going down. All right, that's just one idea. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. Give us a call. Take a look at our website. We'd love to do business with you. Thank you.